What do you really know about your investments and your financial advisor? Gary Cinderbrandt, a veteran advisor and founder of Better Path Training, has spent decades helping both financial advisors and their clients get it right when it matters most. Gary pulls back the curtain on the advisory world to reveal the truths, the gaps, and the opportunities that most people never hear about, but absolutely should. It's about more than money. It's about legacy, trust, and making sure the people you care about are in the right hands. Welcome to If the Public Only Knew. Now here's your host, Gary Cinderbrandt.
Hi, this is Gary Cinderbrandt, and welcome back to another edition of If the Public Only Knew. Here I try and demystify in plain language what's actually going on and help investors and also advisors trying to reach decisions which are based on rationalization, forethought, and a disciplined approach. I would tell you that over the past week, that's been a bit challenging. The things we've seen happen are, to say unprecedented would be the understatement of the year. We've literally never seen these things before. I remember a great quote from the Tom Hanks movie starring in with Sullenberger. The name of the movie was Sully, about the U.S. airline pilot that landed the plane in the Hudson River. And his comment when they said, well, that's never been done before. And Tom Hanks calmly replied, well, everything's unprecedented if it's never happened before. We've never seen this before, not at this level. With tariffs are on, tariffs are off, and who knows what's going to happen next. But it's taking investors and the world in general on an emotional roller coaster. So let's try and unpack that a little bit and understand how we separate emotional reactions from reactions or things that really matter to our longer term approach, whether we're an investor or an advisor. I always used to talk to my clients in my advisory role and gave them a choice very early on. I can tell you what you want to hear, or I can tell you what you need to know. We have to decide right now. There are plenty of people out there that will always tell you what you want to hear. I ain't going to tell you what you need to know. Now, that may absolutely line up with what you want to hear, but oftentimes it doesn't, and it may feel uncomfortable. But keep in mind, the reason you're hiring me is to get you from where you are, which I used to call point A, to where you want to be in your future, point B, taking into account as many knowns and as many unknowns as I can possibly imagine. At the same time, we always have unknown unknowns, things that can occur that we can't even bother speculating on because we can't fathom it'll ever occur, ever. Well, I think we're in one of those positions right now. So what we've got to do is dig a little deeper and understand how emotional bias can come in and wreak havoc with both an advisor's approach and an investor's long-term investment plan at the worst possible time. So let's think about this a little bit. As volatility increases, volatility is the absolute definition of irrational actions. You do not have volatility when people are acting irrationally. You have volatility when people are so far to one side or the other of a particular issue that it just stretches credulity. You can't fathom why it would be there. Now, normally what people will do is they'll have a particular position they believe in. That position is formed from a variety of things, not by reflecting on the experiences of their entire life, but normally that opinion is formed by an emotional response to an external stimulus. In general, people will respond faster to news that makes them feel good or they agree with than to the things they really need to hear. Why? They don't want to rethink their position. If you think about it, you ever think about how long it takes to make a first impression on someone? I think it comes in at under 20 seconds. Once that first impression is anchored, that individual doesn't want to change. They've got to rethink the whole thing and go through that. That takes a long time. So again, we get involved with emotional responses. And if we do that, we're now distorting the rational decision-making that was present at the time we may have set a longer-term strategy that we agreed at the time was the way to go. So what does it do? It starts to trigger biases, which are fueled by the things we put our eyeballs on. Confirmation bias. Think about what you read on your news feed, whether you follow Yahoo, Google, however you set your news feeds up. Your eyes are going to be more drawn to stories you're likely to stay with. Now, doesn't really matter whether that story is complete nonsense and has been debunked. If you believe it, you're going to read it. If you read it, your eyeballs stay there longer. It tells the algorithm other stuff to feed you. And it also brings into play your archetype. And ads are fed to you based on the types of stories you read. So it's not about trying to get you the truth or show you the unvarnished facts so you can make your own decision. It's about keeping your eyeballs somewhere long enough and bringing them back to allow whoever wants to advertise whatever product they're selling to have an opportunity to get you to click on that link. We all fall for it, myself included. It's amazing how sometimes I will just get tied up doom scrolling or clicking on links and I forgot what I went there in the first place for. comforting narratives. As individuals, as human beings, we would rather hear a narrative that makes us feel good about what we're doing. Let's give you an example. People who have had a lifelong addiction to smoking, don't you think they would much rather hear that it extends life and quality of life as opposed to what it really does? Well, we know smoking leads to lung cancer, heart disease, and early death, but people still smoke. This is a form of cognitive, we know it, dissonance. It makes no sense whatsoever. It hurts when I smack myself in the head repeatedly. I know it hurts, but I still do it. Why? Cognitive dissonance. Something basically, I don't want to face the truth of not smacking myself in the head, so I keep doing it. It is a devastating behavior, both financially and personally. Here's what it leads to. People have an aversion to taking a loss. They don't want to do it. They feel much better taking gains. So what happens? Typical portfolio that people run on their own. If I get it as an advisor or you as an advisor, bring it in, you're going to look at it. What you're going to see is that there's a lot of gains that are taken at relatively modest numbers as opposed to losses that can accumulate to very large amounts. Why? No one wants to recognize, oh, maybe that wasn't such a great idea. Maybe I shouldn't have done that. So I'm just going to ride it out. It'll eventually come back. I'll get into that later. Recency bias, overweighting recent events. Today is a perfect example of what's going on. We had the largest drawdown in the equity market. I think over a period of the past 4 or 5 days, the rapidity of it was incredible. It was like a flash crash, or other people call it the Trump dump. And everyone looked at it, and anyone with half an ounce of economic sense understood that if these tariffs continue to propagate, we're going to be facing inflation, a stagnant economy. So we've got stagflation. Welcome back to the 80s. And on top of that, we are going to have an economy that's going to have rising unemployment and incredible unhappiness across the board. So despite the fact that we heard these tariffs were here to stay, well, not so much. About a half hour ago, the president decided, well, I'm just going to take the tariffs off. We're going to wait 90 days and I'm going to let somebody negotiate what happens. So we'll go on to kind of propagating the next disaster, which may or may not impact the markets. But that one for now, it seems like the cat is done playing with the chew toy and Trump's going to go off and do something else. I'll get into this in another podcast where I try and analyze that behavior using an old saw that always guided me called Occam's razor. So stay tuned for the next one. Recency bias. Again, overweighting recent events. If you thought these tariffs were basically going to stay in play indefinitely, why would you be in the equity market? Last time this happened, market entered a depression and basically stayed there. The economy fell out of bed and it was worldwide. It lasted for a long time. So was this that miniature version of that? I don't know. Herd behavior, following the crowd out of fear. I'll talk about the VIX in my next podcast. But again, when you see this type of movement in a market in one day, and the best thing the Treasury Secretary could say last Friday was, well, the good news is the markets continued to operate in an orderly fashion. So we should feel good about that. Great. So I could calculate my losses minute to minute and not be concerned that maybe they were off. Insanity, herd behavior. Everyone, get me out, get me out. No. Why? Did you have a long-term strategy? Did you react emotionally? Or did you try and separate signal from noise? This is an important concept in engineering. It's an important concept in communication. It's an important concept in investing. This refers when you compare meaningful, actionable information, comparing that to distracting information, noise, things you hear, tweets you see, things you see on TikTok or social media that all of a sudden grab the public's attention and go viral. It's noise. Long-term trends don't change based on a tweet or a TikTok video. So if we think about this in the context of financial markets, signals information that really matters. At a fundamental level, are companies making money? Will they continue to make money? Are they run by people that have brains and know how to book profits? Are they consistently raising their dividends over time? What kind of economic environment are they doing it in? Is the economy expanding? Is the economy contracting? Where it's going right now, I don't know. Probably we're going to see a contraction in the first quarter, maybe the second quarter. Does that mean we're in a recession, not in a recession? I don't know yet. I'm really not sure. But I do know that a company doesn't lose 1/3 of its value in 4 days because of some policy that may or may not come true, given to us by an administration that essentially has no idea what they're doing. So why would I react to that? I have no clue what's going to happen or how they're going to change. I have a theory. As I said, I'll get into it in my next episode on Occam's razor. Noise, this is what we react to. The hype, the headlines, social media chatter, short-term volatility that doesn't affect the longer-term fundamentals. To sit and listen to the talking heads basically come in and say the world is ending, or this is the greatest thing that's ever happened, and the United States is going to have trillions of dollars of new investment, and we're all going to get rich. Guys, that's noise. It's just noise. Apple still makes great product, period. Boeing still makes airplanes. Some not as well as others, but they still make them. Airbus still makes airplanes. Things are still manufactured that people want to own. Will it be a price adjustment? Do we know what it's going to cost? No, we don't know that yet. But the fundamentals are still there. You want to plan your future and live your life based on longer-term fundamentals, not short-term noise. So we need to make sure that we focus on the right things. We have to make absolutely certain that we do not allow the media or your news feeds to amplify your emotional response. And I've seen that happen repeatedly. All the positive stories drive excitement. The market turned around today. It's up 2,600 points. Why? They're pausing 90 days on tariffs. Negative truths, things you don't want to deal with, oftentimes freeze you in your tracks. They paralyze you. You don't want to change. You don't want to rethink. So why does this matter for investors and advisors? Well, almost all the time, noise will overwhelm signal. Why? Because noise sells. You don't want to read something that says, fundamentally the market will go up over time. It outperforms bonds by a factor of 2, which outperforms inflation and cash returns by a factor of 2. Set your course, adjust your asset allocation, rebalance as necessary, and never look at it. Well, there goes CNBC. There goes Yahoo Finance. There goes anybody that's trying to trade on their own, because fundamentally that's going to work. Why? It's always worked. Companies that grow value over time, that increase dividends each and every year, that are run by smart people and make things people need to buy, no matter what sector it's in or anywhere in the world that it's made, companies will thrive if they're well managed over time. That's a fundamental. But the world's ending because everyone's going to be tariffed and we're going to go into a deep depression. That's noise. We don't know what's going to happen. So we react emotionally to the noise and we react short term. We ignore the longer term signals that we based our strategic plan on that guided our good decisions. If you're an advisor listening to this, this is job number one. You've got to empathize with your clients, with your investors that basically are just interacting with this information episodically. They're not living it like we are. If you're a good advisor, you are only focusing on signal and you're coaching people through the noise. But we can do more than that. A good advisor should prevent you from having to react to the noise altogether by educating you and giving you the emotional tool set, if you will, as to what to expect and when to expect it. Beyond that, as an investor, your advisor should be reaching out to you, not to calm you and say, oh, it's all going to be all right. Our analyst says this, analyst says that. Frankly, I don't care what anybody's analyst says. As an advisor, my clients hired me. They didn't hire the analyst. They hired me. And I was the one that had to navigate through times like this. The 87 crash, the dot-com meltdown in 2000, the 87 or 2007 to 2009 period. It goes on and on. How did I do it? I got rid of the noise. I reaffirmed what the clients wanted to do. I reaffirmed their goals, their time horizons, and I had a disciplined strategy which worked when markets were up and markets were down. It revolved around having a firm goal that was mathematically solved for, that related back to everything my client and their family wanted to accomplish over that period of time. That allowed me to exercise a discipline which was completely agnostic to what was going on in the news. I didn't react, I didn't overreact, and I spent more time in volatile markets speaking with clients and reaffirming who they were, what mattered, and what they wanted to do. And a year later, or some period of time later, they couldn't really remember the individual event that precipitated all of that emotional response. So, why as an investor do you stay loyal to a strategy that consistently fails? It is a well-known fact that investors that are self-guided underperform in the equity market by between 200 to 300 basis points over the long term. And in the bond market, they underperform by almost 90% of what an underlying bond might do. I'll get into why bonds versus bond funds are a topic everyone should understand again in a later video. But why do investors stay loyal to those beliefs? Well, one of my theories, it's like the Stockholm Syndrome. It's like the devil you know is better than the devil you don't. And you think if you're loyal and you're there long enough, you're going to develop some affinity for that strategy, and at least it's something you understand and you know. Now, as some of you may know, I teach skiing in Vail, Colorado, which I love to do. And I'm consistently dealing with managing people's psychological responses to physical danger. It is a known fact that when you ski, you need to keep pressure on the front of your skis, primarily on your outside or turning ski. To do that, your body must be going down the hill. Well, what do most people do? Almost every skier we see that's not properly trained, they're leaning back into the hill. As they lean back into the hill, the ski that's going to keep them safe and control their speed disengages from the hill. They end up going faster. They end up getting tired earlier, but they continuously do it. Why? Because that's the thing they've been most comfortable with, despite the fact there's a far better way to do it. And just explaining it to somebody or demonstrating it to them, that doesn't work. Sometimes it takes years to develop the ability to break away from a pattern that's holding you hostage to get into something that's going to work a lot better. What's the investment parallel? Investors defend portfolios that consistently underperform. They're loyal to advisors who comfort them rather than challenging what they're doing. Many clients that I brought on board, I was able to onboard because I was able to review their statements and try and correlate what they owned versus what they were trying to accomplish over whatever period of time they were trying to do it. And oftentimes the objection would be, well, I've been with my advisor for 20 years. We've become really good friends. So I have a couple of questions regarding that. First question is, if you run out of money, will your advisor cover your shortfall? No, but I really like him. I understand that. And if you really like him, find out if your friendship survives the fact that you're moving your money, because this is your money. And this is where it's headed right now, because your advisor is clearly much more interested in his bottom line than yours. And he masks that by telling you what you want to hear. Here's what you need to know. If you stay doing what you're doing, you're going to run out of money before you run out of breath. Now, if that works, and that's okay, stay where you are. But these numbers don't lie. Doubling down on losing positions to avoid admitting mistakes. Well, yeah, sometimes clients do that. Client will transfer in. I'll look at a stock position, and my question is, so you bought this particular equity at $40, believing it would rise. These are normally for people that try and kind of self-manage, and it's now $29. Yeah, what's your thought for it? Well, I really believe in the stock long term. We should hold on to it. Okay, great. So if you believe in it long term, let's buy a little bit more. And it's, well, I don't know if I want to do that. Well, if you believe in it long term, why wouldn't you buy more of it? Now, why don't we just watch it for a while? All right, let me ask another question. If, knowing what you know today, if you had this money in cash, would you buy this stock at $29? Well, no. And you just want to hold your head and go, okay, so a purely emotional response got nothing to do with a logical conclusion. And my comment then was, well, based on nothing other than the fact that you've got $29,000 sitting here that's already disappointed you, do you think this stock knows you're here and it owes you something? Or might this $29,000 be better deployed elsewhere? Then I'll normally hear, well, I just don't want to take the loss. Well, you've already taken the loss. The cash isn't there. The only thing we're dealing with now is whether or not we're going to be able to book that loss against future gains. But that's $29,000 that can be better repurposed elsewhere. You watch clients' eyes roll up in their head because they're now dealing with what they need to know as opposed to what they want to hear. And I hear all of these things, and I always did. Paper loss, it'll bounce back. Everybody else is doing it. Blah, 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 blah. No, it's not rational. And your emotions are driving your decisions. So those are just a few things I wanted to bring to your attention. Thanks for tuning in. Please tell your friends. If you like what you hear, stick around. Follow me. Share this show. Download it. Leave me a review. I'll talk to you pretty soon. Have a good one. Take care.
Thanks for checking out If the Public Only Knew with Gary Cinderbrandt. If you found today's episode helpful, be sure to follow the show and share it with another advisor, investor, or friend. For more on Gary, or to check out any links mentioned in the episode, head to the show notes. We'll see you next time.